Welcome back. This is Retirement News Online. The present pandemic has left many people sick and millions without jobs worldwide. Furthermore, political instability and social unrest have plagued parts of the world in the weeks and months following the outbreak of COVID-19. Now, to be sure, the world is experiencing a humanitarian catastrophe that invites no opportunity for financial opportunism. However, it is incumbent on all of us to do what we can to protect our financial futures and safeguard our wealth in such uncertain times. And joining me is Zach Abraham with Bulwark Capital Management in Tacoma, Washington. Zach, thanks for joining us today. So for the investor who is close to retirement, what should they be doing in the climate of volatility and inherent unpredictability?
Well, I think in normal times, contrary to what a lot of people believe, I think in normal times you could predict certain things. You could at least predict volatility ranges. You could predict, extreme events as it relates to asset prices. Think back to 1949 to 1999. That's a 50-year run where you never had a single year in which markets dropped more than 30%. So there's a lot of reasons for that, but one of the reasons for that was there was a level of certainty in terms of asset class returns. That has gone out the window because fundamentally now you're looking at the most expensive market in U.S. history on virtually every metric you look at. It's the most indebted market. This will be the only recession in U.S. history where corporate debt levels have risen, consumer debt levels have risen. So it's really unlike any other situation. And if you look at fundamentals, you could easily and be well inside of historical norms, be looking at a market that based on fundamentals could drop 60 to 70%. That being said, you look at government actions and Federal Reserve actions on the other side of it, and you could easily see a market that was up 40, 50%, possibly even greater inside of the next 2 years. So we have never looked at a market where the range of outcomes was as big. So I think that's an important thing. But what we're doing for those clients and the way we look at it, this seems kind of a milquetoast answer, so I'll elaborate on it a little bit. But really it comes down to diversification, meaning you're looking at two threats. You're looking at a deflationary collapse, like I said, fundamentally justifying a market that could drop 60 to 70%. So security of capital and protection of capital is of the utmost importance. Yet at the same time, you're dealing with a government that between deficit spending and Federal Reserve printing this year, you're looking at somewhere between $13 to $14 trillion created out of thin air. So while we're worried about a deflationary collapse on one hand, we have to be productive with the assets we've got because inflation will unquestionably be a problem going forward. So, and the way you do it, I think it comes down to diversification. I think that you need to have, that fixed indexed annuity that we use as a bond replacement that's insured against loss needs to play a role because that's the money that will be there no matter what happens. And if markets continue to go up, it will substantially outperform bonds. So we win on multiple levels. I think that also having a small portion of your money in CDs for your immediate cash needs over the next 16 months isn't a bad idea. I think having a section of the portfolio that's aimed at dividend paying, traditional type stocks is not a bad idea. I think having a slice of the portfolio that's aimed at more of the aggressive type tech stuff is not a bad idea. And then I also think the introduction of, precious metals, particularly gold and silver at a portion, again, nothing crazy, right? I think one of the most important things that gets overlooked, Scott, in terms of diversification is not just diversification in terms of different asset classes, but also in terms of size, right? To be truly diversified, the sizes of those positions need to be somewhat consistent. So if you have a portfolio, and we have a setup like that we use for all of our clients in or near retirement. And last year, that portfolio was up better than 20%. This year, it's up about 3 or 4%. And at the market bottom there in March, it was only down 6. We look at that and go, that's exactly what. Now, do we wish we would have made more? Sure. I mean, it's not like I'd turn it down. But that's what that portfolio will do for you. You'll get a lot of that upside momentum and a lot of that upside juice, not all of it. But most importantly, when the stuff hits the fan, you're not going to be sitting there looking at a life-altering loss. And again, I think it comes down to diversification. And Scott, that is the one thing missing I see out of virtually every single retail portfolio I look at it. They're all massively overweight tech. And I get it. That's what's worked. At the same time, that'll be what kills them.
Let's talk about diversification now. Would it be accurate to say that a lot of people who believe they have a diversified portfolio of mutual funds, for example, are really not diversified at all?
We see it every single day, and people can do just to prove our point. And I tell this to our clients all the time. Just to prove our point, give them, I'll give them a little homework assignment and say, look, go pull up the top 10 performing mutual funds over the last 2 years. Just go pull up a list of the top 10. You can find it on Morningstar, wherever. You can even just type it into Google, and you'll get results. And then go look at the different names and objectives. You'll see large cap growth. You'll see large cap value. You'll see mid cap and large cap income. You'll see all these different types of strategies, right? And then you go to the holdings section and pull them open, and they virtually all have these same identical top 6 to 8 holdings, regardless of what they say they're supposed to be invested in. So, so these people pick these different mutual funds, and the answer I always get, and they go, they always tell me, they go, well, they've done really well. And I look at them and I go, well, of course they have. They're all identical, and they're all invested in the exact same thing. You're not diversified. But the other thing, Scott, is the valuation spread between growth and value, and most particularly in tech right now. It's a tech mania. And if you look at that spread, we're not just seeing that lack of diversification as it relates to mutual funds. You're seeing it in ETFs as well. So you've got a lot of these, Vanguard only type investors who have really bought, and for good reason. And I'm not dogging on ETFs. We use them too. But not exclusively, but they're a part of a portfolio. Again, diversification, right? But you look at ETFs, and the way ETFs work is they're a black box, meaning no one is making the decision about what goes in and what goes out. All these ETFs, or almost all of them, are market cap weighted. So the bottom line is the biggest stocks in the S&P 500 make up the biggest portion of the investment. So when you purchase an S&P 500 ETF, the minute you do that, 4.2% of your money goes into Apple. 4.18% of your money goes into Microsoft. So when you do the numbers, these people own an S&P 500 ETF thinking they're diversified. And right out of the gate, 25 to 30% of their money is in the top 5 to 6 names in the S&P 500, which are all what? Tech, right? So, and there's 11 sectors. So you don't have to be a math major to realize that if 30% of your weight of your investment is in one sector, you're not diversified. And yet that's the reason why people buy the S&P 500 ETF, right? It's inherently diversified. Well, it's not. And I think that's one of the biggest misconceptions that we see out there on a regular basis is, like you said, because they own these different mutual funds or because they own ETFs, they assume they're diversified. And they're not. They are the most concentrated and loaded up in the most expensive aspect of the, or the most expensive segment of the market. So I think that's gonna surprise a lot of people, and it's gonna shock a lot of people when this thing finally does, go the way of the dinosaur, which it inevitably will.
That's Zach Abraham in Tacoma, Washington. This is Retirement News Online.